All right, welcome aboard, everybody. I hope everybody's having an amazing Tuesday evening. My name is Craig Carlton. I'm with Connected Investors. This is the Investor Connection, and I am really excited that you joined us tonight. We have a very, very special guest in Odeta. And Odeta, I'm going to say it out loud. Is it Kushi or Kushi like sushi? You said, is it Kushi?
Like sushi with a K, exactly. It's Kushi.
I love that. I love that. Well, welcome aboard, Odeta Kushi. Thank you so much for joining me. I'm going to give you an introduction, but before I do that, I want to welcome everybody to our session tonight. You could be anywhere. You're here with us tonight. We absolutely recognize that, so I want to recognize you. So if you would, just like David did, let us know where you are tonight. I am actually visiting my folks up in New Hampshire, so I'm in the great state of New Hampshire tonight. You'd let me know where you are, and then let me know if you've ever been on one of our sessions before. So if you've been on a session, or if you haven't been on a session, type in the number 1 and then where you are. And if you have been to one of our sessions, let us know. Type in the number 2 and where you are as well. We'd love to hear that. And then I'll recognize you as you're doing that. So thank you for that. So, but again, we have a really good episode tonight, a good session, and we're gonna jump right into it. I'm going to be actually letting Odeta do a lot of the driving. I'm gonna be learning so much from her. She's a rock star in this world, and you're gonna get a lot of valuable information. You're definitely gonna wanna watch this again. So we're gonna make it available in our replay section sometime tomorrow. If you don't catch everything or you wanna watch it again, you're probably going to want to. So let me do this real quickly. Thank you, Carolyn, and thank you, Sam. Thank you, Daniel and David, for joining us. Welcome aboard tonight. As you're all coming in, let us know. There's a question box on the right-hand side of your control panel. Pop that little guy out. Please feel free to ask questions. I'm going to be sort of fielding the questions tonight. We'll be passing them off to Odeta. Hopefully, she can give us some awesome answers. So we'll be definitely doing that, but don't hesitate to pop out those questions and ask away. I'm going to use a little cheat sheet here too as I introduce Odeta. So you've been so good, thank you. Odeta is the Deputy Chief Economist at First American. It's obviously one of the largest title insurance and real estate services companies in the US. She's a leading expert on housing market trends, demographic shifts, and the broader economic forces that shape the real estate landscape. You might have seen her quoted on places like CNBC, Bloomberg, and the Wall Street Journal, and she is here today. She's with us, and she's here to share what investors like you guys all need to know about this moment in the market. So, Odeta, I know that our viewers are going to really enjoy this. Thank you for joining us. Thank you so much.
It's really a pleasure to be here. Thank you for having me.
Yeah, very, very good. And Stefania was saying, I don't have access to the messages center. I'm in Florida. I'm not sure what that means, but there is a questions box over there on the control panel. If you're able to locate that, well, you're actually in it right now by typing, now that I think about it. So you're good to go. You're good to go. Awesome. So the first thing they really want to do is let's just get to know Odeta a little bit. Tell us a little bit about who you are and how you got where you are today. Really curious to see what that looks like.
Sure. Well, thanks again, everyone, for joining us. It's really a pleasure to be here with you all. I have been interested in economics for a very, very long time. I went to undergrad and graduate school for economics and really was interested in real estate because when you think about the things that we need as human beings, food, water, shelter, right? So studying something as important as our real estate market was something I was always passionate about. And I always felt that economics was sort of the intersection of multiple disciplines, right? It's a very interdisciplinary major. So math, stats, things I was always very interested in, policy, history, all of those things converge in economics. And so, I'm lucky enough to be living and doing the work that I always hoped to be doing. And these days, my team and we put together forecasts on the real estate mortgage market. I study both the residential and commercial markets. So we produce forecasts internally. We talk to the media about what's going on in the housing market. We try to stay ahead of trends in the real estate market and really study every aspect that touches real estate. And that's really every part of our economy. When you think about it, the labor market, what the Federal Reserve is doing, how that impacts interest rates, where demographics are heading, all of those things are important for the outlook for the real estate market. And I'm hoping to get to touch on each one of those aspects in today's conversation.
Oh, definitely. And what I'm gonna do tonight is in the previous sessions that we've had, we haven't had a lot of PowerPoints, but one of the things that Odeta does is she's really keen with data, and and the data that she provides is really, really valuable. So we're gonna use some PowerPoint slides today. I'm gonna actually let Odeta drive when it comes to the slides. We'll get there in just a second. But before I do that, let's just do one more thing, just as a quick reminder. If you are on the session tonight and you don't have our software, we have a great opportunity for you to pick it up. We have a 7-day free trial. You can either scan that little QR code there that's right on the page, or you can just go to our website, which is connectedinvestors.com, and you'll be able to find the free trial that we offer. So what I'm going to do here, and let's hope we avoid any technical difficulties. I am going to give Odeta control of the slideshow. I'm going to stop showing mine real quick. Let's see if we can do this without causing too much damage. And
I think we've got this. I can see that I can make myself a presenter. So let me give that a shot.
And I got rid of my slideshow completely.
Perfect. All right. Might take a second for it to.
Yeah.
Okay. Let's give it a shot.
Perfect.
Okay, I think we did it. Well, I actually had to scale this back. Believe it or not, when you see these slides, you won't realize, but I had to scale it back a little bit. As you know, as Craig mentioned, I love data. I think that there's having an objective analysis of the macroeconomy and real estate market is really important to cut through all of the noise, all of the headlines. And so please answer or ask any questions. I'm happy to answer along the way. I really just wanted to start out by discussing what's top of mind for everyone, which is the Federal Reserve and all of the things that the Federal Reserve is thinking about when making interest rate decisions. And that starts with their dual mandate. And their dual mandate is an inflation target of 2% and an unemployment target of roughly 4 to 4.5%. It's a little bit more difficult to measure full employment, but their long run target for unemployment is about 4.2%. So we'll call that the target for now. So what I wanted to show on the slide is how we're doing relative to those Federal Reserve targets. And what you see here is that on the unemployment target, this dotted line here, that 4.2%, we're right where we should be. So on the face of it, the labor market looks very strong, very resilient. The unemployment rate is 4.2%. That's in line with historical average, with below historical averages. It's in line with the Fed's target. And so all things look well. I'll give you some reason for concern in the next couple of slides, but from the perspective of the unemployment rate, things look pretty good. On the inflation side, we've been making a ton of progress. As you can see, in 2021, 2022, we started to see inflation pick up significantly. And here I'm actually showing core inflation, which is excluding the very volatile food and gas components. And you can see that inflation's made a lot of progress. We're at about 2.5% year-over-year growth in inflation. So we like to see a 2 on the left-hand side of that decimal, but we're not quite where we need to be, right? The Fed wants to see us at 2%, and we're not there yet. So in terms of where we stand on the Fed's target, pretty good on the employment mandate, need to make a little bit more progress on the inflation side of the mandate.
Just out of curiosity, do you know why the 2% is the number? Is there a reason for that?
It's not too hot and not too cold, right? You don't want 0 is a little too low, probably gets us closer to, deflationary territory. And so it really is sort of this 2% is not too hot and not too cold. And more importantly, what the Fed really wants to do with that 2% is anchor inflation expectations. What they don't want is us as consumers to feel like they don't have inflation under control. And so, when you see headlines in the news about, well, consumers are expecting prices to rise, the Fed gets a little bit shaky when they see those kinds of headlines, because if we as consumers start to act on those inflation beliefs, if we believe prices are going to be higher tomorrow, then we'll go out and we'll buy today and we'll hoard a bunch of things. And they don't want that. So that 2% really sets the consumer expectations.
And so that brings to mind, just on a side note, when everybody heard about the tariffs, I'm sure you're going to touch on those, but when we talked about the tariffs and people were going out and buying all their products before the tariffs hit, is that sort of what you're referring to?
Exactly. That's
Yeah.
exactly what I'm referring to. And that's actually, I wanted to share this next slide with you because I think it makes the point that you just mentioned, which is when we break apart inflation into its main components, uh, what are those components? We have goods inflation, that's us spending on things for, let's say, in the home, right? Refrigerators, things we purchased over the pandemic. I, bought a Peloton that I never used, a bread maker, all of these things. Then you have super core services. That's the part of inflation that is, services are things like you going to the hair salon, or you going to get your nails done, or you going to a hotel, a leisure and hospitality. And I call it super core services because I'm actually pulling shelter out of super core services.
Okay.
Shelter inflation is so heavily weighted in the overall inflation numbers that
Mhm.
I decide to pull it out on its own. It's about 40% of the core inflation numbers.
Mm.
And the reason I'm showing this chart is because you can see in 2022, goods inflation spiked to above 12%. That was all of us, we weren't able to spend on things that we could usually spend our money on, like going out to dinner and traveling. And so we started to purchase things for in the home. We stressed out supply chains. Of course, there were already supply chain issues at the time. We put a lot of pressure on the goods sector, which contributed to skyrocketing inflation in that sector, which has since come down. Here I have the historical averages for each one of these components. And you can see that goods has made a lot of progress. It's really come down from 2022. Now, super core services has also made some progress, not quite back in line with historical averages, but made a lot of progress since 2022. Super core services is very dependent on wage growth. And as we'll get to, I'm sure later, in the labor market right now, we're seeing people really stay put. We're seeing a bit of a frozen labor market.
Mm.
And that means
Right.
we're not seeing as much pressure on wages. So we expect the services component to continue to decelerate. The interesting one, and one that touches all of us in this
Right.
call, is shelter. The shelter component of inflation remains elevated, but I believe that there's reason for that shelter component to come down. Notably, shelter is measured by rents, and we know from market data that rents have not only decelerated, but now stabilized. And the way that shelter is measured in the inflation component is with a significant lag. So the CPI, which is what I'm showing here, actually captures rents paid by new and existing tenants. Whereas, when we look at rents, market rents, that's capturing rents on new leases. So there's a significant lag in this orange line here. And so I expect it to decelerate further. So I do believe that there are some disinflationary forces that are baked into our inflation measures. Where I'm really worried, and you touched on this, is on the goods inflation. That's where tariffs are really impacting us or could impact us. And you're already starting to see this trending in the wrong direction. You're starting to
Yeah.
see this creep higher. And that really is the early impact of tariffs on the goods sector.
So that's going to be folks that are, rehabbing, fixing and flipping, updating their homes when they're buying, wood and materials and stuff like that. Is that what we're talking about?
Yeah, that's part of the story. Absolutely. I
Yeah.
mean, we're starting to see some of the pressure. Well, we have seen the pressure on the construction materials and remodeling sectors as well.
Yeah.
So it is definitely a concern. But as I mentioned, there are also some disinflationary forces in that inflation number as well. But I'm really watching this goods inflation because I think that poses some headwinds to the Fed reaching their targets.
Yeah. You mentioned labor. I'm going to interrupt you one more time. So I know that I have been having conversations, and I know that, if you go on Twitter or I guess X now, and you have conversations, everybody's sort of talking about the labor and the immigration and the deportations. And I don't know, where you stand with all that. How does that impact, like for instance, you hear the stories of home builders and all of their labor's gone because they either self-deported or whatever. What's the impact of the labor market, with that? Are we seeing that right now? Is it gonna lag, or are we actually seeing real I guess the word damage is what I'm thinking.
Yeah, so I mean, there is a significant portion of, especially in the remodeling sector, of the labor that comes from immigrant labor, and so I definitely think that we might start to see some of the impact there. Generally speaking, our population growth in the US over the last couple of years has really been driven by immigration,
That's right.
and certainly the labor supply has been helped along by immigration. And so I do think that we'll feel it, we'll feel it there for sure. But we haven't quite seen that in the data just yet.
Well, and I was reading something. Doesn't that push up the wages though of the sort of the like the I don't want to say natural, but like citizens, their wages are going to go up, right? Or the cost of their labor is going to go up for the builders and the remodelers because they're not going to be paying you know immigrant labor charges. So what's the impact of that? Do you see?
Well, yeah, that's, I mean, that's your supply and demand right there, right? In the construction sector, they've already had to increase wages to attract and retain workers, and they've been facing a shortage of skilled workers since the global financial crisis. That you had a lot of retirements over that period. You had a lot of people leaving the industry, and so they're already facing this chronic shortage of skilled workers. And if they were to lose more of those, how do you attract and retain? Well, you have to increase wages. And so,
Okay.
so I do think that that could be part of the story as well.
Hmm. Okay. Awesome. Cool. Yeah, you're good.
Yeah, no, great,
Next.
great question. Um, I wanted to touch briefly, I know we're on sort of the macro section right now, but I did want to touch briefly since I mentioned rents. The story nationally, especially last year, was that rents were coming down, and it was a result of a lot of supply hitting the market. And certainly that is the story in some markets. So what I wanted to show here is I'm showing the top US markets, and on the y-axis you have rent growth, and on the on the y-axis, and then on the x-axis you have how much we're building relative to the existing stock, and this is of apartments. And what you find is a pretty clear trend in areas where we're building a lot more multifamily units relative to the existing stock are also markets where we're seeing downward pressure on rents. So and this is predominantly in the Southwest and Sun Belt markets. So you see here Fort Myers stands out with a lot of building, and certainly we're seeing that downward pressure on rent growth. Whereas in the Northeast and Midwest markets, different story there. We're not building quite as much, and that's for a lot of different reasons, right? Regulatory challenges, it's costlier to build, etc. But those are also markets where we're still seeing positive wage growth. And so when you see those headlines about a lot of multifamily supply and downward pressure on rent, it's always important to remember, and I'm talking to a bunch of investors, so I don't need to remind you, but real estate is local. It's inherently local.
Yes.
And not only that, but if you zoom out a little bit, even in areas, even when we are building a lot, what we were seeing in the construction data is there were a lot of units that were being brought to the market. But when you look at the beginning of the pipeline, housing starts, how much are we breaking ground on new multifamily properties, that number was actually going down. And so once we've made our way through the units that are currently coming online, nationally, we're going to be back in a shortage situation, which could mean that we're seeing rents re-accelerate. And that's exactly what we're predicting going into next year, is that we might start to see some upward pressure on rents if we don't see more groundbreaking on multifamily properties. And this is nationally, right? Certainly there are markets where we need to wait a little bit longer to see that sort of dynamic. But I did want to make the point that those headlines really mask some regional variation, significant regional variation.
I love this because one of the cool things about the software about connecting investors is we're nationwide, so our folks really are all over the place. I've got Frankfurt, Illinois, and we've got David in Dallas, and there's Boston, and there's California. So we have people that are looking at this chart right now, going, "Huh, what do I do now?"
Yeah, and we have all this as an interactive on our Econ Center. So if you want to poke around and see where you are in this, I know there's some overlapping circles
Yeah.
here, but that trend is stands out quite a bit, right? Especially the regional variations with the
Yeah.
Northeast and Midwest. And you'll see a lot more of this, even on the for sale side. This regional trend is something we're also seeing in the purchase market. But I did want to quickly pivot back to the labor market. I mentioned in my first slide that the unemployment rate is benign, right? It's not telling a very scary story. And I think when we look a little bit deeper, we find that there are some cracks in the labor market that we need to be mindful of. So here what I've done is actually look at the drivers of the unemployment rate. Consider that in January 2023, the unemployment rate was 3.5%, very, very low. And today it's 4.2%, which is also quite low, but certainly higher than it was in 23. So what's been driving that increase since January 2023? Well, unfortunately, it's been predominantly permanent job losers. So these are people that have lost their jobs and are having a difficult time finding work. And that's the most recession relevant component of these drivers. And it's something that we're concerned about, because when we look at the job openings and labor turnover survey, what we see is that job openings have come down. Quits are very low, so workers are very hesitant to leave their jobs, right? They don't think that there's a better opportunity out there for them. They're staying put. The hires rate is at about 2013, 2014 levels, which is when the unemployment rate was 7%. And I say all of these stats and I throw all these stats to tell you that we are in this sort of frozen labor market where we have low hiring, low firing, with some risks to the downside. You know, employers aren't quite firing yet, because they are sort of scarred from the pandemic, the labor market when it was really tough to hire, right? So they're not quite letting go of their employees, but they're also not hiring. And employees are staying put because they're not, you know, they don't necessarily think they can find something better out there. And so
Uncertainty. I've heard you mention that word a bunch.
uncertainty.
We're dealing with uncertainty right now, is what it sounds like.
And we
Yeah.
see that in business surveys, business saying they don't know how to plan, they don't know how to hire, they don't know what's coming. And so I do think that there is some weakness in the labor market data to be mindful of, and certainly that the Fed is mindful of.
Yeah. In that previous slide, I'm just curious. I ask lots of questions. That
Please.
red, do we know what the drivers of the permanent job losers are? Like what kind of, do we know what sectors are losing lots of jobs? Have you had the ability to break it down there?
Yeah, so we can certainly look at what sectors are losing jobs. I don't necessarily show it here, but what I will say is one of the segments of the population that's having a really hard time finding work right now is actually new grads.
Yes.
So those coming fresh out of college and out there looking for work, they're having a very difficult time finding a job. We see that in the data, and certainly we see that in what I call the ANEC data, which is, you know, hearing from these folks that they're having a very hard time finding work, and that's certainly a challenge.
Yeah. On my side of things, I'm saying, okay, well, those folks that can't find a job, let's make a job for you. Let's do some real estate, right? That's what I want to do.
That's a good point. Absolutely.
So, yeah, that's what I'd be doing. I'd be teaching them all how to do real estate for sure. Yeah, that's wonderful.
Fantastic.
Well, thank you for sharing that. Yeah.
Of course. And I just wanted to touch briefly on, you know, I mentioned the recession word. In terms of recession risk, I do think that there are reasons for concern, but I don't necessarily believe that a recession is imminent. And I'll tell you, one of the reasons that I have some concern is because 70% of the US economy is driven by consumer spending. So consumers need to be gainfully employed and out there spending their money. And what we're seeing in the data is that consumers have been spending. That's what's been keeping the US economy so resilient. And part of that story is we've seen wage growth outpace inflation. And so that's been helping to drive spending. But the other part of that story is that it seems that consumers have been financing that spending with credit card debt that they're increasingly unable to pay back. And what this chart is showing you is that credit card debt in both nominal and inflation adjusted terms has increased significantly. And the delinquency rate on that credit card debt has also increased from about 7.5% in 2022 to nearly 12% in the latest available data. So this is certainly a cause for concern because this is it's not necessarily sustainable to continue to drive spending with credit card debt that that we're seeing more delinquency rates increase.
Yeah, that's no good. That's no good. We
No
actually
good.
did a really remarkable session a few weeks back about using corporate credit or using business credit, and it was a really interesting thing. So this is kind of probably a little nervous for some people because they're thinking, oh, I got to spend money to do real estate, but then there's this spending problem. So I like looking at things from this sort of higher level because it's not like a pinpoint into real estate investing, but it's a pretty broad view of what you can expect. So this is good stuff. I love that.
Yeah, and I think I'll try to put it all together on what this all means for interest rates, which is what we all care about certainly, because
Yeah.
all of these factors, whether it be, labor market, inflation, recession risk, all come back to what's the Fed most likely to do.
Yeah.
And certainly Fed action has an implication for interest rates, which is important to our sector. Uh, this quickly wanted to show that I mentioned that recession risk isn't necessarily imminent. When I look at the GDP data, what I tend to look at is I remove the noise from imports, exports, and I look at a measure called real final sales to private domestic purchasers. This is showing you sort of underlying demand in the economy. And what we noticed is that whenever this year-over-year growth of this measure falls below 2% is when we typically start to enter a recession. And it might be hard to see, but in the latest periods, we've sort of just been stable. We don't necessarily see this dipping below that 2% line just yet. I mean, I want to caveat that GDP is a bit of a backwards looking measure, but nevertheless, I think that this is a promising statistic that shows that while there are cracks and there are reasons for concern in today's economy, notably a weaker consumer and some cracks in the labor market, a recession is not necessarily imminent this year.
Okay. Well, that's
And
good news. I mean,
it
I
is
think.
some glimmers, right? We look for
Our fingers
glimmers where we
crossed.
can.
What is it? What is a recession? What's the definition of it typically? What is it? Has
Well,
it been historically?
so funny that you ask because I think the rule of thumb is
Yeah.
2 consecutive quarters of GDP decline, but it is so much more than that. The committee that calls recessions, they're called the NBER BCDC, Business Cycle Dating Committee, and they look at a lot of different measures, everything from income growth, GDP growth, the labor market, and they look at both depth and duration of declines before they make a call that we are in fact, or we were in fact in a recession. So there's a lot of different measures that goes into that, but I think the one that's most cited by folks is 2 consecutive quarters of GDP decline. Yes. And I did want to bring this all together to talk about the Fed. The Fed they just had a meeting where they announced that we were going to keep rates exactly where they were, and then they put out their projections about interest rates for the rest of the year. And what they said is that we might have 2 25 basis point rate cuts in the second half of the year. And these are investor market expectations of Fed rate cuts. And it seems that investors have aligned with the Fed. Investors are also expecting, or 40% of them at least, are expecting about 2 rate cuts this year. And I should note that both investors and the Fed are not very good at forecasting what the Fed's going to do. But that's what they're saying as of right now, is that we'll get 2 rate cuts by the end of the year, and the first one will come in September. So not in July, but in September, and then we'll get another one in December. And this certainly could change if we start to see inflation reacceleration because of tariffs. That reduces the likelihood that the Fed will cut rates. If we see the economy or the labor market really grind to a halt or show significant signs of slowing down, of deterioration, then that will increase the likelihood that the Fed cuts rates. But right now, I think the market has really aligned to expect 2 cuts this year. And that could put a little bit of downward pressure on mortgage rates. We know that mortgage rates aren't directly tied to Fed action. They are tied to the 10-year Treasury yield, which is influenced by all sorts of things, geopolitical tensions, inflation expectations, Fed action, all of that goes into determining what that 10-year Treasury yield is. But we do expect generally that that rates will come down a little bit by the end of the year. Market expectations right now are showing that rates will gently sort of come down to about 6.6% by the end of the year, and then a little bit further in 2026 to about 6.4%. I do think that rates, between 6 and 7% are sort of the new normal in today's market, and historically that's actually not very high. The reason it
Yep.
feels so bad is because we still have high house prices, we still have rising insurance premiums, we
Yeah.
still have a lack of inventory, and all of those things converge to make for a challenging market.
So there's two things that come to mind here. So these rates, so as an investor, we love to look at old mortgages and get those low interest rates because we have this thing called creative deal structuring. So what it looks like to me is that the sub-2, the creative deal market, is still going to be very viable. On the flip side, Odeta, what is, like, if I have a house and I've got a great rate, 2, 3, 4% on my mortgage, it like, why would I even consider as a, as a homeowner getting a large, getting a different interest rate? Like, would that make any, like, is there a way that you could justify it?
Well, one, I will say that the decision to move for someone who owns a home is often driven by lifestyle factors. And so, if you were a millennial who bought their home over the pandemic when it was, just you and your partner, and suddenly you find yourself in a situation where you have your first child on the way, you move because you have to move.
Right.
And a lot of those home buyers gained a lot of equity over that pandemic period. And so they're able to use some of that equity to offset higher interest rates. They can bring a bigger down payment to that closing table and offset higher interest rates. And we are seeing that homeowners are increasingly coming to terms with the reality that mortgage rates are not going to come back down to 3%, right? We went through these
Right.
like stages of grief, right? That's
Yeah,
kind of
exactly.
how I saw them, where
Yeah,
we
yeah.
were first in denial, like, of course, mortgage rates are going to come back down.
Some of us are
And now
still
I think we're
angry. We haven't moved
in,
on yet.
there's still, yes. Um, Absolutely, there's a lot of anger out there, but I do think we're coming to the stage of acceptance. But that's not to say that the rate lock-in effect won't continue to hold back the market. I think about 84% of existing homeowners today have a rate below 6%. And so
Mhm.
you're still going to see that rate lock-in effect hold back market activity. But I do think that as more new home buyers lock into higher interest rates and as rates come down a little bit, you'll continue to see an easing of that lock-in effect.
Yeah, yeah. Nice. Good. Love those numbers.
Yeah, I did want to touch quickly on demographic trends, long-term demographic trends. I do think as investors, that's very important to be thinking about not just the next year or two, but over a longer-term horizon. What does it look like? And I did want to show a map of the domestic migration rate from 2023 to 2024. Anything in green is net in migration. Anything in blue, or the darker the blue, it's net out migration. It tells a story that you're all familiar with, which is that we saw a lot of net in migration and continue to see net in migration to Sunbelt markets and out migration from places like Southern California, New York City. And so I do think that this is a trend that's been going on over the pandemic and today. It's worth noting that population growth in markets like Florida and Texas, while they're still positive, it's less so than it was during that period. So we have seen a slowdown in that population growth in those key markets.
And I'm in Florida, so I'm seeing lots of the
Yeah,
prices are coming down. There's lots of inventory right now. It's very interesting in this area. Well, certain areas have lots of inventory. So, and there's
that's
not nearly as
exactly
much
it.
price battling. There's not nearly as much of that. Like, you're not getting people that are, 10, 15, 20% over asking. They're fighting for lower than asking right now. That's what I'm seeing. I don't know if that's consistent, but that's what I'm seeing.
That's exactly right. So, Southwest Florida, parts of Texas are some of the markets where we're seeing negative price growth, or at least flat to
Right. Yeah.
negative.
Yep.
Some of the hottest pandemic housing markets are now sort of mean reverting. But in Florida, you also have, higher insurance premiums that are starting to kick in and really impact the affordability equation. And so
Yep.
you're getting that double whammy is there as well. I won't spend too much time on the next couple slides, but this slide in particular is showing you that there was a period in time where there was this misnomer that millennials were never going to purchase homes. And the reason for that misnomer is because if you look at the 30-year-old millennial, here I've got age on the x-axis here, and I'm just comparing homeownership rates for different generations at the same age. So the 30-year-old millennial had a homeownership rate that was about 6 percentage points lower than their generational predecessors, the Gen Xers and the baby boomers. And so people were looking around, seeing that number and saying, okay, well, this generation is not interested in homeownership. They don't want to buy homes. And that's just not the case. Our research has shown that millennials are very much interested in homeownership. They're just doing it later in life than their predecessors. And it's
Right.
because they're making these key lifestyle decisions like getting married and having kids later in life, in their early to mid 30s, unlike their predecessors who were making these decisions in their mid to late 20s. And as evidence of this trend, when you look at the 42-year-old millennial, their homeownership rate is, right in line with the Gen Xer at the same age. So again, this is a generation that has a homeownership rate just over 50%. There's a lot of millennials on the sidelines, still aging into their 30s, waiting to make that decision, waiting to jump into homeownership. And I think this really is a tailwind for housing demand over the next several years, especially if we see some improvements in affordability, which we are anticipating. And I'm sure this Gen Z stands out a little bit. Like, why is Gen Z outperforming all generations in their early 20s? I think this is a little bit of an outlier. This happened over the pandemic when rates were, 3%, and
Right.
we were untethering ourselves from the downtown office with our
That's
ability to work
that's
remotely.
right.
And
That's
so
right. Yeah.
they're going to look a lot like the millennials if you look at the older Gen Zers. So this is a bit of an outlier here.
Yeah. No, I got that. That's really interesting because I do hear that quite a bit. We're never going to be able to afford a home, and I think it really is lifestyle. I think lifestyle has a massive impact on it. Like kids saying, I'm going to go live in a van down by the river for the next 4 years. You're not buying a home, right? But they're saving their money. So you hear that
Mhm.
all the time of people that are making lifestyle choices so that they can get into their homes. This is really encouraging. That's really encouraging. Yeah.
Absolutely. And the other thing is, and we're expecting this population to grow, those 30 to 39, that population is projected to grow. And then the flip side, of course, is the baby boomers, because millennials are the largest living generation, but baby boomers are a very large generation themselves, and they're
Yeah.
starting to enter their 80s. So we're going to see a lot of boomers aging into their 80s in the late 2020s, early 2030s. We'll start to see them age out of homeownership, and this is expected to bring a lot of supply online. But what we noticed in our data and analysis is these homes are in prime locations, but they'll need a lot of work.
A
So
lot of work. Yep.
a lot of work to be made, interesting and appealing to that next generation of buyers. And so we think that this is, by definition, the fixer-upper will be popular again as
Yeah.
these baby boomers age out of homeownership. But it's not a silver tsunami, it's more of a silver glacier, right? Demographic trends take time.
Okay. So nice and slow. Love it. No
That's
tsunamis.
right.
That's good.
That's right.
I love that. I think of all the equity though that are in the homes, but then as an investor on my mind, I'm thinking, well, I know there's a lot of equity, but there's going to be a lot of work. And
There's going to
I
be
say
work.
this lovingly, my mom and dad, they're getting older in age and they're not doing home improvements. Their parts of their house are starting to deteriorate a little bit. And the ironic part is the value of their home keeps going up and going up and going up. So
Yeah.
even if they do decide to sell it, even if they're selling it, if we're thinking it from an investment standpoint, your repair cost, you're going to be able to really use that equity as your leverage. So what you're sharing is that the boomers that are starting to age out of home ownership are going to have all this equity, but they also, a lot of them know, I didn't do anything over the last 15, 20 years, and so I'm going to play with that equity. So when you're on the call tonight, listen, we talk about equity being the place where you make all your deals. I would say, just on a side note, I would start looking for areas and communities where the homeowners are starting to age out. You can sort of get to them before they start moving, because those are going to be people that go to the realtor, but really realtors in many cases simply can't help them because of the condition of their home, right? So that's what's coming to my mind as I'm hearing this. I don't know if
Yeah,
that's
and
right or not, but
interestingly, about 40% of owned homes in the US are owned free and clear. And
free
a
and
lot
clear.
of those, yeah, without a mortgage, and a lot of those are by this baby boomer population that's been in their home for some time and paid off their mortgage and sitting on a ton of equity in a home in a prime location. So,
Love that. Love
um,
that. All right, so just a quick question. I don't know what
sure.
your next slide is, but I have something that I wanted to ask. What are some areas that you've discovered for some distressed properties? I know it's a little bit outside of what we're talking about here, but do you have any sort of data about certain areas of the country where they're seeing more distress than others?
So it's interesting you asked that. I'm going to move along because the next section was all about the supply shortage with, I think, you're all aware of the supply shortage. There's actually
Yep.
a pretty good, there's a pretty good article today in the Wall Street Journal talking a little bit about potential distress, but let me just focus on this slide really quickly. So in order to have a foreclosure, you need to have this dual trigger event. You need to have some kind of income event. So someone loses their job, or both, homeowners lose their job and they're unable to pay their mortgage, and a lack of equity in that
Yep.
property. And what we're seeing in today's market is that the labor market remains resilient. So most folks, still have their jobs, and people are sitting on a ton of equity, especially if you bought your home pre-pandemic or even before 2022. And so I like to show this slide because what it's showing you is the top part is showing you how much house prices increased from pre-pandemic to peak, and then from peak to current. And what you see is that there are still markets here, anywhere that's covered by this green arrow here, where prices continue to grow, where these markets have not seen price declines from the peak. They continue to reach new heights. Whereas markets on the left side of this chart are markets that are experiencing price declines from the peak. In other words, if you bought at the peak in Austin, you might be seeing 10% house price declines. And if you bought in San Francisco at the peak, then you're also experiencing anywhere from 7 to 10% house price declines. But if you purchased before then, check that out, right? 30% year over year growth in house prices in San Francisco and 65% in Austin. So the folks I'm worried about are those that really bought in 22, in 23, and are now in some of these markets here on the left-hand side of this chart, and they might be facing some distress.
Yeah.
But generally speaking, in the housing market today, we're not anticipating any sort of foreclosure wave. Certainly nothing like we saw in the global financial crisis. We will see some pockets of distress, especially among FHA borrowers. We're seeing a little bit of distress there. Folks who bought in markets that, during the peak that are experiencing house price declines. But, our credit profile for this cycle has been pretty strong. We're still seeing a ton of equity in the market.
Yeah.
Mortgage debt to income is still historically very low because people were able to refi into those 3% mortgages,
Yep.
and all of that bodes well for potential distress.
Yeah. Yeah. I was going to say, this looks like it's driven by equity. So.
Yeah, there's still a pretty significant equity cushion in today's housing market. And I don't know if I did want to show here, like, the foreclosures remain more than 50% below pre-pandemic. And I do think that there have been, an increase in the share of underwater properties in places like Cape Coral, Florida, and some in Austin, Texas, especially for those who bought at the top. They've seen their value on their home slip. So there are some pockets of the country where we're seeing that, but certainly nothing national that I'm concerned about at the moment.
Right. Got it. Let me ask you this on
Yeah.
the foreclosure market. Is there is there kind of, I don't know if the word threshold is right, but is there like a level that lending institutions are kind of just like, all right, we're just going to have to deal with it? You know what I'm saying?
Like a baseline level of
Of,
foreclosure in the
yeah,
market?
yeah,
Yeah, I think that's a really good question. And I've been at a lot of conferences where it's been brought up. It sounds almost cruel to say that there's almost a baseline level of foreclosure that's expected, but I think
yeah,
that's the conversation that's being had. It's what's acceptable. And certainly you can see there's been a structural shift in the number of foreclosure starts in the economy post-pandemic. I think there's a
yeah,
lot of reasons for that. Partially, this was driven by the moratorium, but even in
yeah.
today's market, it's staying quite low. And I know that in some markets, it's very difficult to foreclose on a property. It takes a very long time, right?
Right, right, right.
Years. So I
Some
don't
places are
certainly
like,
don't
you're
have the
done, we're out,
answer.
you're out.
Yeah.
Texas, you're gone. See ya.
And certainly it's a question that I've heard a lot. Certainly I don't have the answer to it, but it is a good question.
Yeah, nice, awesome. Um,
Oop, I'm clumsy. I keep clicking different charts. Sorry here for the whiplash on
so
the
no worries.
chart.
So you're not expecting the rest of the year to be a wave of foreclosures, just going to kind of stay steady the way that it is. It's going to happen, but not
I
no big spikes.
I do think we'll see a steady increase, especially as we start to see the labor market continue to slow.
Right.
Um, as the labor market slows, I think you'll see more distress in the market. And so I do expect more of that this year, but certainly not, a big wave of foreclosures. And I think every time I mention foreclosure wave, people immediately take themselves back to the global financial crisis. And so
Yeah.
I always like to repeat that we're not expecting anything of that magnitude simply because, this time it's totally different.
Yeah. Okay. Perfect. Phew. Huh. That's,
Absolutely.
yeah. So let's talk a little bit about price and affordability.
Yeah. So I wanted to show this chart quickly because it's very similar to that multifamily chart I showed in the beginning. Here are markets where we're seeing where we're comparing price growth to how much we're building in these markets. So the y-axis here is annual permits issued per 1,000 households, and the x-axis is yearly growth in sales price. And the relationship that this chart is showing is that the more that we're building in these markets, the more downward pressure that we see on house prices. So before it was on multifamily rents, now we're actually talking about house prices. So, again, Austin, Tampa, Jacksonville, really an overrepresentation of southern and western markets here. In areas where we're building a lot more, we're seeing downward pressure on prices, whereas on the bottom right quadrant, you see markets like Buffalo, New York. I was raised in Rochester, so it's a market that's literally close to home. You're seeing sales prices continue to rise, and that's because we're not necessarily building quite as much in these markets. So, there's more pressure on prices. So again, that relationship holds. In areas where we're building a lot more, you see a little bit more downward pressure on prices.
Wow.
And in terms of affordability, whenever we talk about which markets are affordable, one thing that always annoys me is that typically folks use average incomes. And when you look at an average income, you're actually taking into account both owners and renters' income. But when we're talking about affordability, we're typically talking about that potential buyer that's currently a renter, right? We're not
Right.
talking about the homeowner. By definition, they can already afford a home. So what we've done here is we've taken the median renter's income in each one of these top 50 markets, and we're saying, what share of homes can you afford in your given market? If we were in a perfectly equal affordable market, you would expect that median renter would be able to afford, 50% of homes available for sale.
Right.
And unfortunately, what we see in today's market is that that's not the case. Nationally, that median renter can afford, I think it's about 26% of homes available for sale. But when we look at all top 50 markets, there are some that are more affordable. Memphis, Oklahoma City, Detroit, Columbus, Ohio. These are all markets where that median renter can afford, more than 35% of homes for sale. And then on the opposite side of this chart are markets that are not so affordable for that median
Yeah.
renter. LA, Sacramento, San Diego.
I'm going to steal this from you, Odeta, this slide, because this is the question that we get all the time. Hey, what are
Okay.
great markets? And this is really, as a fix and flip, it's a buy and hold. You want to be in markets where your rents are affordable. So this slide is awesome. I'm gonna steal it from you.
Please do,
This is
please do.
good.
And we have a lot more on our Econ Center as it relates to affordability. But this one always stands out to me because, California is so
Right.
represented on the, this side of the affordability equation, but we certainly still have some markets where that those rent the renter can afford to buy. And in today's labor market, where a lot of workers are, again, untethered from the downtown office and they're able to
Right.
maybe move to a more affordable
Yeah.
market, I think this is even more important in that sense.
Very cool. Yeah. Um,
How are we doing on time here?
I
Like I
think we're
said, I
getting
could
pretty
talk
close.
forever.
I can listen. I do have a couple quick questions for closing, but I also wanted to say that we haven't had a lot of questions. I know it's because Odeta's giving you great information. You're just absorbing it. But if you have any questions, please pop them in the questions. I have a couple. So a Gallup poll showed for 12 years in a row that real estate is the preferred long-term investment by the majority of Americans. What are your thoughts about that? Sort of looking at all of this data. I'm new to real estate. I want to get in. Odeta, should I?
Yeah, I mean, from the perspective of as someone who studies homeownership for a living, I always say the decision to buy or rent a home is a personal decision first, but from a financial perspective, housing wealth is the primary driver of wealth creation in this country, and it has been since I've been able to measure it with the data. And that's particularly important for those on the lower end of the income distribution. So when we break apart net worth and overall wealth, the component that makes up the biggest chunk, especially among lower income households, is housing wealth. And
Yeah.
so I do think that, it's, again, homeownership is a primary driver of wealth creation. I think that will continue to be the case for years to come in our country. So I am very passionate about that. And I
Yes.
always do like to mention that there is an income story here. It's particularly important for those in the lower end of the income distribution. It makes up a bigger chunk of their overall wealth.
Awesome. And you know what? Let's. I'm gonna ask you one last question. And this is really sort of the closing question, which is, as we move forward from today, moving forward, let's go 18 months. What are you sort of seeing? What kind of? And I don't want you to make predictions, but what are your sort of like things to maybe watch out for? Maybe one good thing, one bad thing. I don't know. What do you want to share?
That's a great question. I know I've talked about the macro to death at this point, but I
Yeah.
do think so much of our industry we're a very interest rate sensitive sector. We're very cyclical in that way. And so watching what the Fed is going to do, almost trying to predict yourself where the economy is going, is so important, more important than ever. And in order to do that, you really have to look at the higher frequency data that we're getting. So if you want to know where the labor market's heading, you look at things like unemployment insurance claims, and you see those start to trend higher. You know that we're trending in the wrong direction when it comes to the
Right.
labor market. Tracking the inflation data. So I think keeping an eye on the labor market and the inflation data, I think is more important than ever to try and get some insight into where monetary policy might be heading, which will give you some insight into potentially where the real estate sector is heading. But with that, I should say, even if we head into any sort of recession, the housing market tends to be the first one in, first one out of downturns because we are so interest rate sensitive. And so, even when things are bad, there's some glimmer of hope in the real
Yeah.
estate
Sure.
market. And
Yeah.
on the positive side, demographics over the next several years, I think, are still supportive of more housing demand.
Nice. So Luke asked, for the rest of 25 and 26, do you see the market favoring more rental properties or fix and flip? If you look at it like that, what would you say?
Sorry, can you repeat that? I was not, it
Yeah,
broke
so
up.
the question is really based on whether they should approach a fix and flip where they fix it and sell it retail, or they buy and hold.
That might be a question right back to you, Craig, honestly.
Yeah, yeah. So what I'm going to say is I think that it's going to also be a very personal choice. What is your risk level? What are you wanting to do? If you're kind of a hands-on person, you want to get in there and do the fixing and flipping, then you're going to know that all your costs, labor, insurance nowadays is more expensive. Everything's a little bit more expensive, but because of continuing pricing of houses rising in many areas, you're still going to be able to do very well. Now, the key is, remember, something that we said a little earlier was those folks that are looking to sort of I forget the phrase when they're not going to be in their homes anymore. What is it called again? They're homing out, not homing out.
They're aging out?
What are they doing?
The aging out of homeowners?
Aging out of their homes.
Yeah.
Yes, thank you. Sorry, the word just kind of escaped me. That's where you want to focus. Those folks are going to sell, and again, they're going to need a lot of work. So those kind of homes are perfect for fix and flip. The rental markets, we talked that rental markets are still very strong in some areas not so good. So I think, again, it's going to be really your risk tolerance, and then also, what are you good at? Do you want to have homes and be a landlord, or do you want to do the work? Or do you want to just flip homes, right? You can still wholesale, right? You can find a home, get a great deal, make a cash offer, and then go find a buyer and go focus on markets where those those fix and flippers are looking for properties to do. So that would be the answer, I guess, that I would say. Awesome. Awesome. Well, you shared what you were thinking. I really appreciate that. This is really, really good. I will tell everybody that Odeta had put a slide up on there, and I hope that you took a picture of it or you did a screenshot. But what I will tell you is we're going to send all of her info out after our conversation. You absolutely must go to her Twitter. Gotta go to, or I'm sorry, it's X now. So go to her X. I've actually been a few times. I think there's great information, but I've also heard people talking about how much they love her X feed. So you're getting live, up-to-date information there on X, and so definitely get there. And this is one of the areas of real estate that I think a lot of investors they see it as a very macro thing, kind of like this distant, oh, I don't know about the markets, I'm just going to work right here because real estate's local. But I think having a broad picture in this way, I think, is really, really important. So I'm super thankful that you shared with us, Odeta, all this knowledge. I think it's really, really good stuff.
Thanks so much.
Yeah, and then David said, as an investor, should I be investing in rental or fix and flips? Again, David, I think it's just going to be a matter of what your personal, what do you want to accomplish? Some folks just want to do quick in and out, right? So you're going to wholesale. Some folks want to make a little bit more money, but they want to get their hands dirty. So that's a fix and flip. And then those folks that want to play landlord or hire management companies, those are your buy and hold. I will say this, I agree with Odeta. I don't think housing pricing is going to crater at all. I think buying and holding it's the easiest, fastest way to long-term residual wealth. So, and plus you create legacy when you own property. So that's my thoughts. Well, good stuff. So don't forget, we have our free trial as well. I'm going to, let's see, the trial, anything else? What it is you're going to get training every day, live, free. So don't forget that if you join up. We're also running one other thing, just one little thing. If you sign up for a subscription, you're going to get a special on your skip traces. You need to be able to connect with these folks. And so normally I think it's $500 for a basic subscription, but if you sign up with the free trial right now, you're going to get 7 days to play with the software, get really familiar with it. And then once you have decided, yes, I want to do this, you're going to get 2,500 skip traces every month as part of your subscription for the life of your subscription. So if you stay active, you'll always have 2,500 skip traces. And as an investor, you're going to need them, I promise. So I love that. So Daniel has decided he's going to continue to fix and flip. So you've made him feel comfortable, Odeta.
Okay.
Awesome stuff. Well, look, I'm gonna go ahead and we're gonna end the call. I'm gonna just again thank you so much, Odeta, for joining us tonight. It was really insightful. I'm gonna make this available as a replay, everybody. We're gonna send you all a thank you email afterwards with all of Odeta's information. This has absolutely been a pleasure, Odeta. I really have enjoyed getting to know you and listening to you. I'm going to keep following your X. I'm going to keep going to your podcast because the lady here is full of amazing information. So I appreciate you. I know that everybody else does.
It's a pleasure to be here. Thank you for your time. Have a great evening, everyone.
Yeah, thank you very everybody. Have a great night. We'll see you in a couple of weeks. I don't remember the next topic, but we'll see you in a couple of weeks. Stay safe, get out there, invest in real estate. There's no better time than right now. So great stuff, everybody. Have a great night. Thank you, Odeta. I'll talk to you again soon. All right. Thanks,
Thank you.
everybody.
Bye-bye.
Yeah, bye-bye.